Hi, everybody. Scott Riley with the Market Update Desk, powered by Mortgage One, February 15th. Wow, here in West Michigan, we got a good amount of snow last night that started coming down about 5 in the morning. Definitely made the trek to the office this morning a little slippery, but senior analyst Mr. Gibson loved it, and he was frolicking out in the snow, plowing his way through it in the backyard this morning. So we've actually got a good start to the market today, and I wanted to kind of go over why. And it is some of the things we've been talking about specifically here. Retail sales, this was much anticipated, and it was going to be market moving. So, retail sales for the month of January came out, and it came in at minus subtraction negative 0.8%, which was significantly worse than what was expected at a minus 0.1%. Even when stripping out core retail, even when stripping out automobile sales that were down 0.6%, the core retail sales were still down 0.4%, which was much worse than the expected 0.2 gain. Um, Now, year over year, we're up 2.5%, which is the slowest pace since 2019, excluding COVID. We expected this. The research told us this, the in depth analysis. We talked about the buy now, pay later, how that was propping up artificially strong Christmas sales, and now we're starting to get that. Yesterday, we had Fed member Goldsby talking about that, hey, just a blip report does not constitute a pattern, and that we still should be looking at cutting rather than keeping higher or raising. So this less than expected retail sales was a very pivotal number and confirmation of what we've been talking about. Luckily, today we're gaining some back that we lost earlier in the week from the inflation numbers. Jobless claims, kind of a plus and a minus on this. Initial claims fell 8,000 to 212,000, which is actually a surprise based on all of the layoffs that have been announced and the cutting and the lack of job creation. Specifically within the Challenger jobs cuts. But when we go into continuing claims, those rose 30,000 to 1.895 million, the second highest reading since November of 21. So the fact that we've been hearing all this information about and talking about from the media how strong the employment market is and the jobs picture, it's not what they've been saying because they lack the depth of going into the reports, understanding the jobs that were created almost unequivocally are all part-time or low-paying positions, and in a lot of cases seasonally adjusted. Another report today came out, the industrial production and capacity utilization. This fell 0.1%, which was lower than the positive 0.3 increase that was expected. This is continuing to show weakness in manufacturing, capitalization, utilization, or how maxed out capacity is at factories, fell from 78.7% to 78.5%. Now, this is definitely a deflationary signal that we're seeing and should raise some caution flags. Weakness in Europe. There's some things going on over there. Japan released their Q4 figures, which were negative for a second quarter in a row, which is generally the telltale sign of an economy that's going into recession. We also saw some weakness out of Europe, showing that they were seeing global economic weakness. The globe, we're all interconnected, and recessions most times are synchronized. We're not out of the woods yet, and we still may see a recession here. There's a lot still to play out, and we're not where we need to be by any stretch of the imagination. The Fed has the tools to keep us out of it potentially. It depends if they wait too long to cut rates. On a technical analysis, mortgage bonds have broken back above their 200-day moving average and are now at a very important 100.427 Fibonacci level. Now, this is a very good technical signal. If bonds can remain above the levels where they're at, there's a lot of room to the upside, reaching up to the 25-day moving average. The pivotal part will be tomorrow's PPI or wholesale inflation data, which very likely is going to tell a different side of the coin of what the CPI did. The main thing with PPI is there's no housing element in the numbers, so we're not going to get that very volatile owner's equivalent rent that caused the spike in consumer inflation. So that's going to likely be a very good catalyst to help us out tomorrow. Interesting also, listening to a report on CNBC this morning, Warren Buffett and his firm have started a process of trimming down their massive stake in Apple. So they're starting to sell off a lot of their shares of Apple. Now, keep in mind they had just a gigantic stake in the company. So it could just be a natural balancing of their portfolio, but it is something to watch. We are starting to see, some concerns with the levels that are within the tech sector, especially the Magnificent Seven. We just never want to go back and see what we had during the bubble in 97, 98, 99. So hopefully that plays out in a positive way here. We'll keep you updated. Give us a call. Get pre-approved. We'll help get your offers accepted. Scott Riley at the Market Update Desk, your singular source in West Michigan for market knowledge. 616-293-2189.